Hi guys, welcome to another video by Optionables. My name is Saket and in this video we are going to discuss about something which has been making the headlines since yesterday. That is 16450 call option trade which happened at 14:18 or 2:18 p.m. yesterday. So this was a freak trade which made a lot of news, and in this video we are going to try to understand why exactly this happened and what was the reason behind this, and also how we can actually avoid this. So to understand this, we have actually consulted lot of experts in the industry, so we get a better idea of the same, and I will be sharing the same in this video. So I would also request you to like this video and share this video with as many people as possible. So the idea is many people actually understand what was the real reason behind this trade. And apart from that, if you're liking the content on this channel, don't forget to hit the subscribe button so that you get regular content updates from our channel. Thank you so much. So in this video, we'll be covering 7 aspects of this free trade. So the first one is what happened. The second one is why did this happen. The third one being why was this not recorded on any charts. Fourth one, even though there was a freeze limit, what exactly happened to that. Fifth one is it okay for such things to happen. Sixth one is, has it happened any time before. And finally, how can we avoid it. So all these 7 aspects will be covered in this video, and we'll be quickly starting off with the first one, what exactly happened. So first we will try to understand what exactly happened. So yesterday around 2:18 p.m. suddenly there was a freak trade, which means 16,450 call option which was trading around 80 rupees suddenly traded at 800 rupees. That too with a huge volume of over 6 lakh quantities within a minute. And this was obviously something known as a freak trade. Why? Because this was not even recorded on the charts. So now people actually freaked out because it was a freak trade, right? And people had kept stop losses at 120, 200 and different levels like 250, and all of these stop losses got triggered and they just couldn't understand why. So all this happened within a minute of time, and this was not even on charts. So when they went back and actually saw the charts, the candle had not even reached 200 rupees. So they now were really wondering what exactly happened and why their stop loss got triggered at 400 and so on. So this particular trade actually made retailers lose lot of money. So some people lost in thousands, some people lost in lakhs, and some people also lost over 10 lakh. So in this video, in the further aspect of this video, we will be covering as to why exactly this particular thing happened. So now we will understand how did this exactly happen. So the most obvious answer would be the stop losses would have been triggered like a domino effect. So let us understand this even well. So what would have happened is, if the option is trading around 80 rupees, generally people would have kept the stop loss at 100, 120, even up till 160 and 200. So this is where most number of stop losses would be concentrated. So now what will happen is, if you have kept a stop loss market, so the option will get traded at the next available market price. So let's take an example. Let's say I have shorted at 80 rupees and kept a stop loss market at 100 rupees. So now it goes and triggers the stop loss, right? Let's say the next available market price is 102 or 103, and it goes to 103 and gets cleared at 103. At 103, someone else's stop loss will also get triggered, and if they have placed a stop loss market, it will further push the price higher and it will go to 105. So this way it keeps on going up until, let's say, it goes till 150, 160, and later what happens is, beyond that there will be no much of orders available. So what happens beyond, let's say, 160 or 170, the next tick can be something like 178. After that, the next tick can be something like 202, and so on. It can jump in multiples of 20s or 50s for very next tick. So this is absolutely possible because beyond a price point, not many orders will be there. So the next obvious question would be, while all of this happened and I could actually see my stop loss being triggered, why was this not on the chart? So why did the charts not record this? So for this we have to understand how exactly the chart records the data and why this was not recorded. So the thing is, any chart you open, no matter you open on Kite or TradingView, it records data second by second. So that is for something like 2 o'clock 18 minutes 1 second, 2 o'clock 18 minutes 2 seconds. So this is how it records the data. What happens between these seconds is not being recorded. So what we have to understand is 1 second is equal to 1000 milliseconds. So anything can happen within this 1000 milliseconds because there are algos which can shoot order with less than 5 milliseconds. Right? So when this happens, all these data actually don't get captured on charts because the entire trade would have happened just in matter of few milliseconds. So for this reason being, even though most of the stop losses were triggered, nothing was recorded on charts, and all of this just happened within a second. That's why even though it went to 800, it was not recorded. Between seconds, not even within a second, between 1 second to another second, all of this trade has taken place. So now we will try to understand who would have actually placed these orders so fast. I absolutely can't sit in front of my computer and place the orders so quickly. So who would have actually done this? So what we have to understand is more than 90% of the trading volume in India is created by institutions, prop firms, as well as high frequency trading firms. So these actually push the major orders in India. So now what would have happened is, let's say a stop loss gets triggered, and that too a stop loss market order gets triggered. So now this HFT firm or high frequency trading firm, it will quickly identify this and immediately place an order. So this would be happening, and suddenly what happens is when this firm actually, or when this algorithm actually identifies that 16,450 call option is trading at a much higher price than 16,400 call option. That can't absolutely happen at all, right? Because always 16,400 call option will be trading at a higher price compared to 16,450. So now what will this firm start doing is, it will immediately start shooting sell orders for 16,450 call option, as well as immediately start shooting buy orders for 16,400 call option. By doing this, they will actually end up making free money, because once it actually trades above 16,400 call option, it's technically free money, right? So what you have to understand is, for a retail person like you and me, the order execution time is somewhere around 100 to 200 milliseconds. That means in a second, the best I can push is around 4 to 5 orders. But these high frequency trading firms push orders as low as 5 to 10 milliseconds. That means they can literally push 20 orders more than us in the same amount of time. And they can also push somewhere around 200 orders within a second. So this is the speed at which they work. So obviously, when they identify such things happening, they will quickly start shooting orders. It won't be a single firm, it will be multiple high frequency trading firms which will quickly start shooting orders, and all of this will get filled. Why? Because everything has been placed in stop loss market order, and whatever is the next available ask price, the quantity gets traded there. So this way, most of these firms would have ended up with very good profits yesterday, because they would have got to sell 16,450 CE somewhere around 800 rupees also. The next question what we have to ask is, why did the upper circuit not get hit and the option went to a freeze? So that is what we have to understand next. So the next question is, when there was a freeze limit or the upper circuit limit at 512, even in spite of hitting the upper circuit limit, why did the option not freeze? So we will try to understand this now. So not long ago, just around 5 days back, on 16th of August, NSE came out with a circular where it said that it will be removing all the freeze limits. From 16th of August, no equity derivative contract will be coming with an upper circuit or a lower circuit limit. So even though this is there, it is not valid, which means option can get traded at any price. So is it good or bad? In some cases this is good, but people are actually using this loophole to make profit also. So then how is this actually good? So this is good because sometimes what happens is when there's a violent move, the option actually freezes. You won't be able to trade in this option. And suddenly when there is an unfreeze of the option, the price will be 100 or 200 rupees higher than the last traded price or when it actually got freezed. So this is a huge issue for many traders because suddenly they will end up losing 100, 200 points from their option where actually they intended to sell it for 10 or 20 points loss. So this is one of the concern which NSE tried to address. So this has actually given ways to a new loophole where people can trade options even at 1 rupee in the morning and also at 800 rupees in the afternoon. So the next question what we have to ask is, these players obviously have a competitive advantage where they will be able to place the orders in few milliseconds, something like 5 milliseconds or 10 milliseconds. Isn't it unfair to retail traders? So that is what we'll be addressing now. The thing is, what we have to understand here is these high frequency trading firms would have paid crores to develop the infrastructure. So to get the data faster, they will try to set up offices very close to the exchange itself. So they would have invested heavily on the infrastructure, lease lines, as well as servers. So the thing is, the cost will go up even to crores in some instances, and they will also have to buy lot of licenses to carry this out. So now you tell me, let's say you end up spending 5 crores on setting up this HFT infrastructure just to get the data 5 or 10 milliseconds faster. So is this wrong? So the question is, I have spent 5 crores on developing this infrastructure. So won't that person at least want some competitive advantage over a guy sitting in Bangalore and doing YouTube videos? Obviously yes. Otherwise why would he actually spend 5 crores on setting up the infrastructure? So it is obviously not unfair because they have actually spent so much money to get the data few milliseconds faster. So before, few people had asked me what was the need to get the data so fast. So the thing is, this is the actual need because you can actually end up gaining a competitive advantage over a normal retail trader if you can take the trades faster. So it is absolutely not unfair. So they have spent a lot and that's why they are being rewarded for the infrastructural setup. So if you see, I am using a 2-year-old phone as well as 1-year-old laptop. So obviously a person in Mumbai who has set up an office next to NSE would want at least few milliseconds faster trade execution than me. So this is the reason why this is completely fair and there is absolutely no issue with this. Everything is happening in the open market and nothing is a shady deal. So the next question would be, has this happened before? Trust me, this has happened to us many times before. So I am going to give you examples of both freak trades as well as the stop loss market domino effect. So I am going to tell you both. So the first thing is about the freak trade. Not long back, maybe a month or so, so there was a freak trade which happened in Bank Nifty put option. So what exactly happened was we had actually taken a short straddle on intraday basis and we had kept a stop loss at 450 rupees. So now suddenly the stop loss got triggered at 450 and when we actually looked at the prices, they were around 340 and 350. And when we also looked at the charts, the high on the charts was only 375 rupees. So this has happened many times. This is just one of the instances, right? So one more instance where stop loss market domino effect happened to us was with the trade in Tata Steel. So what we had done was we had actually shorted lot of put options of Tata Steel. So Tata Steel was trading around 535 and we had actually shorted 525 put option and it was expiry day. So what happened during this time was we had actually shorted 525 put option at around 2 rupees and we had shorted more than 100 lots. So we had around 1.2 lakh quantity in Tata Steel. I know it's a very foolish thing to have so much in stock options. We had shorted around 1.2 lakh quantity at an average price of somewhere close to 2 rupees and the current price was somewhere around 1 rupee. So we were more or less sure that it is going to go down to 0 and we can pocket some nice profit of 2 lakh. So later what happened was, so we saw that and we kept a stop loss at 1.5 rupees thinking that okay, even though it hits our stop loss, we'll definitely be in profit. So the last traded price was around 0.8 to 1 rupees. It was trading around that range. So now what happened? There was a sudden dip in Tata Steel. It actually, end of the day, it ended at 0. But in the middle, there was a sudden dip in Tata Steel, and the price actually got triggered at 1.5 rupees. So for our bad luck, we had kept a stop loss market. So now I'll tell you what exactly happened. So most of the quantity, luckily, so because when the price is trading around 1 rupee or 1.5 rupees, what do you expect? The stop losses will also be around 1 rupee, 2 rupees or 3 rupees. You usually don't see people keeping stop loss at 10 rupees or 13 rupees when an option is trading at 0.8 rupees. So this is what exactly happened. So luckily for us, most of the quantity, over 50% of the quantity, got cleared between the range of 1.5 to 2.5 rupees. Remaining 20% of the quantity got cleared somewhere around 2.5 to 3.5 rupees, and post which actually came the bad part. So beyond this, there were no orders for the sufficient fill to take place. So after that, what started to happen was it started to get cleared at 3.6, 3.7, 3.8, so on, and it also went till 4. Once it hit 4, there was no more orders at all. It quickly started to jump to 4.55, 6, 7, and believe it or not, the last lot got cleared at 13.7 rupees. So we had kept a stop loss at 1.5 and the last lot got cleared at 13.7, almost 12 points of slippage because I had placed the stop loss market order, and the option actually ended at 0 end of the day. So the thing is, here we learned a very important lesson. So the average price at which we cleared the Tata Steel option was around 5 rupees, and we lost 3 rupees on 1.2 lakh, where we booked around 3.6 lakh net loss from that particular trade. So this is one instance which I wanted to share, and post that actually many people also asked in the live trade session why you don't place stop loss market. For the same reason, post that we only place stop loss limit orders. So next we will also address the issue of how actually you can fight such issues, or how you can actually avoid being trapped in such freak trades. So now we come to the last part of this video. How can we avoid such things from happening? So the most obvious way is to keep a stop loss limit order. So when you keep a stop loss limit instead of stop loss market, what you do is you place the price and the trigger price with a difference of around 5 to 10 rupees. For example, if you are placing the trigger price at 100 rupees, then place your price or limit price at 103 or 105 rupees. Give it some sufficient room. Why people most likely miss the stop loss limit is when they place something like a trigger price of 100, they put the stop loss price as 100.5 or 100.2. So these are the cases where the stop loss can actually miss. But when you give it some sufficient room, the chances of stop loss missing is very little. So now the option prices are not also going to freeze because of the new NSE circular, which means that when you place the stop loss limit, there are always chances that the market price can actually come down, trigger, and again go up. So compared to stop loss market, stop loss limit will actually end up saving a lot of money to you. So one more thing what you have to remember is, if you are placing stop loss limit, you should be in front of your screen always, because you don't know if it gets missed, then you don't know what will be happening. So it is always good that you should stay in front of your screen always if you're placing stop loss limit. So this is one way how you actually can try to prevent this. So in spite of this being done, you will still end up losing money in case of such freak trades where stop loss limit also doesn't get triggered and suddenly the price also jumps, so your stop loss completely gets missed. So in that case, all of us will have to take a loss, because the thing is, we are not really equipped to place the orders in such a low latency time. So this is the entire summary of what exactly happened and why did this exactly happen. And we have also made a video on HFT trading, and you can check that out. If you're actually seeing it on the laptop, you should have a pop-up on top, which you can definitely check it, right? So with that, we also come to the end of this video, and I hope that you guys have liked this video and you have got something to learn from this. If yes, then please do hit the like button, share this video with as many people as possible, and subscribe to our channel. And I'll be seeing you soon in the next video with more such content. Thank you so much for joining.